In this screencast, we are going to continue our work with variation on problem P1-4b from Financial Accounting, the 8th edition by Weigand, Kiso, and Kimmel. So when we left off last time, we had just completed these financial statements to be used by interested users in accounting information. Now, in accounting, we don't actually use this format to record all of the thousands of transactions that might occur in a business. Instead, what we use is an account. That's why it's called accounting. Now, in an account, we just record all those increases and decreases, just like we did in this particular table. But what we use is we use a three-part account, which contains a title, a left side, and a right side. The left side is called the debit side, and the right side is called the credit side. So all of these things that we recorded in two different places will also be recorded in two different accounts in our new format. Now, as it happens, to remember, how do we increase and decrease different accounts with our debits and credits? Well, as it happens, assets are increased with debits. Again, debit just means left. And liabilities and shareholders' equity are increased with credits. And credits just means right. And one way you can remember this is that assets are on the left side of our accounting equation, and they are increased on the left with a debit. And liabilities and shareholders' equity are on the right side of our accounting equation. They are increased with a credit, which is on the right. Of course, you can't forget that expenses and dividends over here in shareholders' equity are actually negative shareholders' equity, so they're the opposite of shareholders' equity. Instead of being increased with a credit, expenses and dividends are increased with a debit. So I'm just going to hide our financial statements for now, and we are going to look at how we would record properly all these transactions. So what we do is we would record these transactions in a general journal. And a general journal just has all these complete effects of the transactions in a chronological order. As you can see, it starts with May 1st and goes down through May 30th, just like our transactions over here. So these are called journal entries. What we put in the general journal is a journal entry, and it shows our debits and our credits. Again, the debits are on the left and the credits are on the right. It shows our different accounts, just like over here we had different accounts, cash, accounts receivable, supplies. Here we have all of our different accounts listed, and the accounts we are debiting are to the left, and the accounts that we are crediting are a little to the right. And then there is an explanation of what happened. And I only put one explanation here. I put all of the journal entries in here already, just for the sake of saving some time typing. So how do we do a journal entry? Well, what you would do is you'd look at the transactions just like you looked at them when you were filling out this table. On May 1st, Paulus invested $8,000 cash in the business in exchange for stock. So you would write down the date, May 1st. Cash was increased. We increased cash and all assets with a debit. So you would put cash over here to the left and you would debit it $8,000. Now common stock, which is part of shareholders' equity, is increased with a credit, and we did increase our common stock. So we would put our common stock a little off to the right here beneath our debits. Our debits are listed first, then our credits. And we would put the $8,000 in the credit column. On May 2nd, we paid $800 for office rent. That was rent expense, which we listed in the expenses column. We would specifically say rent expense. We wouldn't just put down rent here or expense here. So we have rent expense. On the 2nd of May, we debit that for $800 because, again, expenses are a negative shareholders' equity. So they are the opposite of shareholders' equity. They are increased with a debit. And we credit cash because cash went down, and we decrease assets with a credit. On the 3rd of May, we purchased $500 of supplies on account. So an asset went up, supplies, and so we would debit that. and we didn't pay for it, so our accounts payable also went up to increase a liability. We credited, and we did credit that for $500. Our advertising expense on May 5th, we paid $50. We increase an expense by debiting it for $50, and we credit cash for $50 because cash went down, and to decrease our assets, we credit them. On the 9th of May, we received $3,000 cash for services provided. So we received cash, we increased our cash, and that was revenue, and we increase our revenues with a credit because they are a positive part of shareholders' equity. On the 12th of May, we declared and paid a $700 cash dividend. That is a debit to dividends because, again, they are an opposite, a negative in shareholders' equity. We would debit dividends, $700, and credit cash for $700. On May 15th, we performed 3,300 services on account. So it's on account. We are owed money. We have another asset, accounts receivable, for $3,300, and we received service revenue for $3,300. We would credit that. Then the 16th, you can see we do not have a journal entry for the 16th. As we said over here in the very first screencast, hiring someone is not actually an economic event because this particular engineer isn't even starting until June. There is no money changing hands, and the company doesn't even owe the engineer any sort of money. So there's no reason to record this. So we move right on to our transaction on the 17th. And on the 17th, we paid $2,100 for employee salaries. So on the 17th, you would record a debit to your expenses because that's how you increase an expense, is by debiting it, $2,100, and you would credit cash for $2,100. On the 20th of May, you paid for the supplies purchased way back on May 3rd. So you look way back on May 3rd, you had this credit to accounts payable because you increased a liability. Well, now we're down here on the 20th, we're paying that off. We're going to debit that accounts payable for $500, and we're going to credit the cash because we are decreasing our cash. On the 23rd of May, we received a cash payment for the services that we provided up on the 15th. So that means we received cash, so we need to increase that particular asset, but our accounts receivable up here that was an asset have gone away because we received the cash. And so in order to decrease an asset, accounts receivable, we credit it for $2,000. On the 26th, we borrowed $5,000 from the bank on a note payable. So that means we received cash from the bank. That would be an increase in cash. We would debit it for $5,000. And we have a liability that's increased, notes payable, $5,000. On the 29th, we purchased office equipment for $2,300 on account. This is an asset, office equipment. We'll use it in our business, and it increases with a debit, $2,300. Of course, we didn't pay cash for it, so we owe money, accounts payable, $2,300, a credit, which increases that liability. Finally, on the 30th of May, we paid our utilities. That is an expense, so we increase our utilities expense, $150, and we decrease our cash, $150, with a credit. In the next screencast, we will look at what we do with all of these journal entries to get them into those financial statements that we talked about in the previous screencast.